What's up, everybody? It's Jonathan from LoneWolfDayTrading, and I'm going to switch it up just a little bit. So, of course, I'm a day trader, LoneWolfDayTrading. So, a lot of people, they ask me, hey, I want to get a day trading. There is a lot that goes into it. Is there another way that I could possibly, invest my money, reap the benefits, but not have to get into the whole thing of day trading? And there actually is. So, I would explain myself, but of course, I'm not a financial expert. There's actually a gentleman that is very good in finances, and I think he would do a better job of actually explaining it than I would.
Let us start. What about the mutual fund? देखिए म्यूचुअल फंड बड़ा सिंपल है, बहुत सिंपल है कि म्यूचुअल फंड हाउस में जब भी पब्लिक पैसा इन्वेस्ट करती है तो वो म्यूचुअल फंड हाउस आगे कैपिटल मार्केट में इन्वेस्ट करता
है. Okay, I wasn't really expecting that. It's fine. I'll just reiterate what he said. So basically, your money's going to start at the mother house right here. See, the MF house. Now, from the MF house, it's going to move up to the capital market. The capital market's going to shoot you over into this tornado type deal, and it's going to launch you into these spikes just like a Mortal Kombat fatality. That doesn't sound right. Okay, I'm just going to explain it myself. Let's get into it. Okay, so that's not what he said, but how badass would it be if it was? That would be awesome. So, as you probably heard him say, today we're going to be talking about mutual funds. So, what exactly is a mutual fund? A mutual fund is a composition of different shares, businesses, corporations into one fund. Instead of just investing solely into, let's say, Apple or Tesla or however, you're going to be getting a small slice of each of those into that one fund. Additionally, unlike day trading, someone else is going to be managing your money. You don't have to worry about going into the stock market, making the trades yourself, or however. A good pro to the mutual fund is you just give your money over to somebody and they invest it for you. Now, of course, there's always cons that come along with that, but we'll get into that a little bit later. So what I have pulled up here is the different mutual funds that my bank offers. Now, depending on your bank or even your investment firm or however, there's going to be different mutual funds. Now, a mutual fund it can start with really any investment amount. Now, with my bank, I have 500, I have 1,000, I have 3,000. I even have $50 with $50 monthly. That's also an option. So right now, I have very aggressive selected. Now, within the mutual funds, there's different levels. As you see here, we have conservative, moderately moderately aggressive, so on and so forth. Now, with conservative, if you were to select a mutual fund with conservative, you're basically going to be looking at like bonds. Something that there's not going to be a good amount of return on it, but you're not risking really any money. So maybe in like 20 years, you'll gain like $1, but you might just lose $1. So that's really how that goes. Now, when you get very aggressive, you're going to be dealing with stuff with like, foreign, really anything foreign. That's going to be very aggressive because there's a lot of risk when it comes to anything very foreign. As you've seen with the news, the whole thing with China tariffs and everything is going on. So that could really impact your mutual fund as far as if you're going to gain, or if it's negative, then you're gonna lose on it, unfortunately. Now, I am not a financial expert. I hold no finance degree, no finance background. I could go on forever. Just know that don't do what I say. Okay, so with that said, very aggressive is something that you want to look into when you're younger. Reason being is your returns could be much greater. Depending on the manager that you have, and we'll cover that as well, you could have a large amount of return. Now, the closer you get to retirement, you don't want to be as aggressive because you're about to take this money out and, basically live off it for the rest of your long life. So for very aggressive, you're going to see these large returns. I mean, this is basically breaking down the returns right here. Now, to give an idea of this whole chart, we have the Cornerstone Equity Fund. For one share within that mutual fund, $14.37. It's just like buying a share of Apple. There's going to be a price associated with that. There's going to be a price associated with this. Now, that's very important when it comes to averaging your mutual fund, which a lot of people don't understand, and it pisses me off because people, especially the career that I work in, they have their own type of mutual fund, but they never explain the averaging, which kills me. Okay, so with that said, this is going to give you the year to date So basically, you're probably going to lose. Now, this is based off of the prior results. So, based off the years past, and the year to date, 6.5%. That's basically what you'll go down. A year is right here, and then 5 years, it starts to level off. Now, the expense ratio, what is this? Expense ratio is basically the fees that are associated. Now, the managers of these funds don't do this for free. They don't do it for free. They probably make a lot of money, but they don't do it for free, unfortunately. Now, when it comes to the mutual fund, you want to make sure that you select a manager that knows what the hell he's doing. It's a good way. You can always just look it up as far as who manages this fund. You want to know how many years of experience does this guy have? Does he have a good track record? Is this the first time he's managed something? What has his past results been? How much has his return been? Heading this mutual fund. Has he been managing this specific fund for a large amount of time, or did he manage something for 20 years in the past and now he switched over to this? It's very important to look that up, because basically you're giving him your money and then you're saying, manage these funds for me. Hopefully the guy doesn't suck, but that's however. So make sure that you look that up. It's very important, especially when it comes to the expenses that are associated with that individual. If you're looking at a return of 5%, but the guy's expenses are 5%, then what's the damn point? So very important when you're looking that up. Now, for people that aren't very familiar with the market or really even how it works, how can they get just, a basic idea that's going to give it to them in plain English? Not all these big words trying to hide stuff. The Morningstar ratings is basically going to give you, it's on a star, how many stars out of 5? This one has 3 out of 5. This has 5 out of 5. Holy shit. That's probably good. Let's go ahead and click into this one. Okay, so the initial investment minimum is $3,000 and it's very aggressive. Now, this could be a good one for someone that's just starting out, really basically coming out of high school or college or however. Now, if you're about to hit retirement or getting closer to that, you don't want to get into very aggressive. Because let's say you put $100,000 into it, you lose 20%, you retire next year. Yeah, nope. How are you going to buy the Corvette after that? So, $3,000, very aggressive, and it has a 5-star. If you want a more depth look, you can always just look online, put in Morningstar review, put in the mutual fund that you're looking at, and it's going to give you a good breakdown. Who's the manager? Who's looking at it? What are the returns into a great depth? How much are the expenses associated with it? So again, just giving it to you in plain English. Now, the big thing that kills me is no one wants to cover the average. You're going to hear this from a lot of people. They're going to say, put your money into a mutual fund and just add to it. Just add to it. If it goes down, then just add to it. It's going to work out, because sooner or later, it's going to go back up. And that's the big selling point, especially in my business thing that I was telling you about. That's how they sell it to these young people. They say, hey, put your money into this and just keep on. If you put it into the SPY, the S&P 500, and it goes down, just put more money into it. And it'll eventually go back up. And yeah, going back to the timeline, and that's why I had to pull up my chart. If we look at the timeline, yeah, it has gone up. It truly has. If we look all the way in January 2016, the high was $188. If we want to look at here, January in 2018, the high is $284. It has gone up. The SPY is going up. Now let's take it back a little further. We're going way back right now. So the interesting thing is it going to go? It's going to keep on going up. Is the SPY going to keep on going up? It may and it may not. It was just like with the whole cryptocurrency with Bitcoin. Bitcoin flew up to over $20,000 a Bitcoin. And now look at it. It's at 4,000. Now, of course, cryptocurrency isn't as stable. So that's probably not the best example. But I'm just saying it doesn't always have to go up. Let's take a look here. In September of 2007, it was at 100, we'll say 150. So September 2007, 150. We go all the way over here, and what is that? February of 2013. Basically 5 years later, it's the same price. 5 years later, it's the same price. So the thing is, people keep on saying, add to it, add to it. And yeah, you could, but you need to focus on the average. And that's just the thing that really kills me, is the whole averaging part. Yeah, you could buy it, let's say you bought it here in January of 2018, 286 was the high. 286 didn't happen again until August of 2000. So basically 8 months later, it's the same price. Now, if you did buy it on these dips, you added to it, but you had to have to make sure that when you're adding, you're keeping the same amount of, like the same price. If you bought like $3,000 right here, and then you only bought $50 worth right here, your average isn't going to change. It's going to stay basically right up here. And then if you want to pull out your money, well, you better wait 8 months so you can basically just break even. So you just have to be very important when it comes to averaging the mutual fund. Yeah, it's good to put money into it. Trust me, it's good to put money aside into a mutual fund, but you just want to be smart about it. You truly do. Don't solely listen to what someone says about just keep putting money into it. It'll go back up. It'll go back up. Well, I mean, yeah, let's look all the way back up here. And someone said when it was at this amount, it'll go back up. We had to wait 5 years for it to get back to the same price. So just be very cautious when it comes to anyone, including this guy right here, telling you how to manage your own money. Because finances is the biggest thing when it comes to any type of negativity. If it comes into a relationship or anything like that, if your money isn't right, you're not going to live a happy life. Poet didn't know it. I'm on it again, right? So just make sure that you're doing your own research and truly being smart about the decisions you make. I really hope you guys enjoyed my video. Again, this is just a very short, brief explanation of what a mutual fund is. Now, of course, with Lone Wolf Day Trading, I am a day trader, but it doesn't mean I can't give people information about other ways that they can invest. I'm not solely just looking at day trading and pushing people to be day traders. I just want people to be financially comfortable, so they can live their life, because life is very short. It's too short to live under the stress of managing finances or being in debt for the rest of your life. There's other routes you can go. You don't have to just be a day trader. Again, thank you all so much for your support. I truly do appreciate it. We're almost to 200 subs. And of course, I'm going to have some crazy video for that. So I'm really looking forward to it. Again, this is Jonathan with Lone Wolf Day Trading. Stay green.